And welcome back to the course on Forex trading. In this section we will be looking at the types of analysis that you can perform on the Forex market. So there are three distinct types on the Forex market, and these are fundamental analysis, technical analysis, and sentiment analysis. Now the two main ones are fundamental and technical, and at the end of the day you'll be picking between one of these two. Sentiment analysis, as we'll discuss, is kind of a supporting type of analysis. Fundamental analysis. This type of market analysis is based on the belief or pre-emphasis that somewhere out there in the world there's information or knowledge that is not yet reflected in the market price. And traders who use fundamental analysis believe that they can take advantage of that by entering into the right position, whether it's a buy or sell. Fundamental analysis involves things like reading and understanding news about certain currencies, understanding the global economic climate and what trends are happening there and what's going on in the world that is actually affecting these currencies. Understanding what's happening with resources, because a lot of currencies actually correlate with resources or are heavily dependent on the supply and demand for certain resources. One of the very convenient ways of doing all of this is through a economic calendar, a calendar of economic events. It kind of sums up all these things that are happening in the world for you. Of course, you have to do your own research, but it's a good starting point, and that's exactly what we'll be looking at in the fundamental analysis section. I'll show you how to properly read a Forex economic calendar, show you a really good one, how to derive insights from it, and how to actually trade currencies based on the calendar of economic events. Also, one more thing that you should keep in mind is that fundamental traders get very attached and very intimate with the currency pairs they trade. So a fundamental trader wouldn't be diverse across all of the currencies that you have in your terminal, but he would just pick one, two, or three, like for example the British pound dollar, the British pound Australian dollar, maybe the euro British pound, and he would, because he would know a lot about the British pound, he could trade crosses of the British pound, and also each one of them would be very unique because only certain events affected, only certain types of resources affected. And being a fundamental trader, you have to develop this, and you will develop this kind of intimacy with the currency pairs you trade. You become very good at them. So on one hand, you become like a expert at those currency pairs that you trade, but on the other hand, a lot of the knowledge and skills that you develop within those currency pairs are not applicable on other currency pairs. And that's kind of the two-sided coin of fundamental analysis. Technical analysis. This type of analysis is based purely on the belief that all available information in the world is already accounted for in the price. And therefore, all you need to do is analyze the charts. Because if all the information is already contained in the charts, then there's no need to analyze news, interest rates of countries, or even events like wars or very good harvests in different countries that affect these currencies, because you are assuming that all of that information is already reflected in the price at any given point in time. Traders who use technical analysis believe that prices move in trends and historical patterns tend to repeat themselves. And that is what a technical trader would take advantage of. Seeing a certain situation that he's seen before and knowing how it resolved in the past, he can make a certain assumption of how it will resolve today and based on that make predictions and enter the market. In a way, technical trading is more precise and definitive than fundamental trading. Because in fundamental trading, you have to use your own expertise, knowledge, and assessment of the situation. You are expressing a subjective view on what will happen. Whereas in technical trading, you are looking at patterns which happened in the past and based on that information deriving certain rules for your trading systems to act in the present day. Therefore, you're being objective. That's a very big advantage of technical analysis. It removes psychology from trading. So you're not worried about whether you made the right call or not, because you have taken yourself out of the equation. Once you've set up these rules, all you have to do is follow them strictly and precisely. If you've set them up correctly, you should make a profit with a very high chance of success. Therefore, you're not worried and staying up late at night or not being able to sleep. Another good advantage of technical trading is that in contrast to fundamental analysis, you don't have to develop an intimacy with the currency pair you're trading, because charts, of course, different currency pairs will have different styles of charts, different types of movements, but so long that you've learned how to analyze 1, 2, 3, 4 different currency pairs, you will start seeing consistent themes across different currency pairs. And you will be able to easily switch between analyzing different currency pairs because you're not that invested into the knowledge base of a certain currency pair. You don't have to look up economic events about it. You don't have to know who the key spokespeople are for that country and interest rates and so on. It's very easy to switch between charts and takes the minimal amount of time to adjust yourself to a new currency pair, and therefore you have the luxury of trading a much more diverse portfolio of currencies when you're using technical analysis. Sentiment analysis. So personally, I think that sentiment analysis is valuable, but at the same time it's not substantial enough to be a standalone type of analysis that you can base your forex decisions on. I think sentiment analysis is more of an auxiliary type of analysis that you can, and you probably should, add to your own analysis to make it more robust. So sentiment analysis implies trying to assess and understand the general mood in the market, what traders are thinking, what their expectations are. And a good starting point for that is Twitter and Facebook. So you can go on Twitter, search a currency pair, and see what people are thinking, what they're talking about, what they're kind of expecting. And also you can find that out on Facebook, in certain groups, in certain circles, other social networks like Google+, basically any type of social network, including forums. Why it's important? Well, because at the end of the day, people make transactions in the market, and it matters what people think, especially when it's a lot of people thinking up. You know how ideas can be viral sometimes, and something can pick up out of nothing, like somebody says the euro is going up, and then just spreads very quickly across Twitter, and everybody starts feeling that way, and then in a matter of an hour or so you actually see the euro going up. Once again, it is rare that just purely sentiment drives the market, but it's good to assess it and keep it in the back of your mind. Also, sentiment is reflected often in currency pairs. You'll eventually learn how to pick it up from the charts, some types of sentiment. For instance, a good one is when traders are uncertain and they're nervous, you'll see consolidation on the chart. So the price amplitude will be reducing substantially. And moreover, we'll actually witness some of these situations in our live trading on a real account in the further sections of this course.